Hey guys, welcome to the RE Source. We're doing something completely new this week. We have a very special guest host. It is Barry Habib, all the way from the East Coast. I'm super excited to have him on board. He hasn't been with us yet. He's been on National Real Estate Post with our friends in Frank and Brian several times. And Barry is one of the smartest guys I know in this entire industry, and he has killed it consistently. He has been right on the 10-year. He's been right on housing. He's been right about the Fed. He's been right about a lot. And so lately we've heard a lot of talking heads really talking about Brexit, and there's a lot of craziness happening. There's a lot of peripheral advice coming out. So if you're watching TV, you may be getting scared a little bit. So I called the smartest guy I knew, and I wanted to pick his brain and say, what does this mean to us in our industry? Break it down on our level, because he's a master at doing that. What does this mean to me as a realtor, and what does this mean to me as a lender? So Barry, can we pick your brain a little bit? You've been right about a lot. We trust you more than pretty much anybody in this industry. So can we pick your brain today and talk about that a little bit?
Love it. Thanks for the great job you guys do. Love your show.
Thanks, Barry. And you killed it, by the way, on the 10-year and the house. I mean, we've called housing several times. So I want to definitely, for the people that haven't seen you before, trust me, Barry's almost always right. Not 100%, but almost always right.
Well, nobody's 100% right, but we did say not too long ago, both on TV and on many of these shows, I remember saying on CNBC that we saw the 10-year going below 1.5. People thought I was nuts. Frank and Brian did a show, and they got a lot of comments on it, thinking that couldn't happen. I thought we did 39 on the 10-year was the target. In fact, just as we're putting this together, the 10-year just ticked down to 142. So we're awfully close to that. I think we may hit that, and we may even go a little bit lower for a few different reasons that we could talk about.
Okay, can we start with, let's break it down, leave stocks and bonds away for a minute and just say, let's concentrate. If I'm a realtor, can you explain what this all means to me? What's happening across, the pond over there with Brexit, can that affect me as a realtor in my business? Fewer listings maybe, fewer sales, does that, touch values at all?
Here's the deal. The Brexit issue is one where it's going to have less of an impact than people think here in the United States. However, what it does mean for real estate, and this is what you have to watch for, is now, is there a market where a lot of individuals from the UK would come to the US and purchase properties? If that's the case, they become more expensive for them. Now, this hasn't hit the euro, which is a much more widespread currency, and that's going to be areas like New York, that market around the East Coast, Florida, where you have people from Europe come and purchase. You're not seeing that big differential in currency where it'd be like, okay, now it's so expensive that maybe it could hurt value. And when you're part of the United States, you do get a lot of people from Asia. And in fact, the dollar has gotten a lot weaker against the Japanese yen. So that is actually a positive for those markets for foreign buyers coming in. So we haven't really seen a detrimental situation. They have to watch this because the European Union can begin to unravel a little bit. There's, the next thing you might hear, you heard it first here, is something called Nexit.
Right.
So this is where you have the Netherlands thinking about their own referendum to leave. And then if that happens, who's next? And when we see that start to occur, that level of uncertainty could disrupt the financial markets. But as you know, in these situations, the beneficiaries usually the bond market. So what does that mean? A great place to be is in the mortgage business and the real estate business, because every time we get those situations, rates drop, it makes real estate more affordable, it makes the refinance market and the purchase market increase. Yeah,
if Nexit happens, we'll have to give you a call and have another whole conversation about that. But you mentioned the mortgage industry. Let's talk about what this means to me as a lender. Obviously, probably rates are going to be fairly good, maybe spur on some refinance activity in the near future. But what about a year or two out? What's that look like if I'm a lender right now?
Well, if you're a lender, obviously you got to be careful on servicing side, because servicing values are going to get hit here because we're going to anticipate a lot more refinances. Look, I think that the big picture is I see a recession coming. I'm convinced of that, but look, let's face it, it's no big deal to call a recession. We always get recessions. It's a cyclical economy. So the trick is when. So there's a couple of things I'm looking at. I'm looking at the fact that the stock market may lead the way, because I think stocks are pricey, I think they're vulnerable, and I think we should be a little careful. 7 consecutive quarters of declining earnings on the S&P 500, that's not inspiring a really strong stock market. Think of it as we haven't had a lot of other alternatives because the Fed stripped that all away. The Fed said you can't put money and make money anywhere. So people are actually investing in stocks, not necessarily always for capital appreciation, but for yield. Isn't that crazy? And they're investing in bonds, not because they get a yield, but because get the capital appreciation. The world is upside down, so you have to be very careful in navigating through these very volatile times. The other thing is that the stock market PE ratio, price to earnings ratios, they're historically high, but you really have to be careful here, read between the lines, because there's a lot of BS in there.
Yeah.
Okay. For one, options-based accounting rules have changed. So you're not expensing options, so you really have a hit to your earnings, which is not showing up. The other aspect is they're buying back stock at a record pace, which means that when corporations buy back their stock, they, for optics purposes, make the PE look lower. It's already high, but under normal comparative purposes, it'd be much higher. I think it's risky. One more thing about this, unemployment rates. Unemployment rates are very low at 4.7. Recessions don't occur when unemployment rates are high. They occur right after we hit the low and start ticking higher. And what that means for mortgage rates is that you'll see them go lower, perhaps much lower. For real estate, with the exception of the last recession, led by a housing bubble, housing always does well during recessions. So this is a great industry to be in, is housing and mortgage.
That's exactly why I wanted you on. There's a lot of craziness, fear going on, and I knew you could just kind of calm the market down a little bit for us, at least the Resource Nation that's watching. Guys, Barry, again, is one of the smartest people in the industry. He runs MBS Highway, and if you click on the link below, right now he's being nice and he's offering a 2-week trial for anybody that subscribes. So I would absolutely suggest that you guys click on the link. You can hear more stuff like this. You get to hear him every day. Matter of fact, our call was interrupted with one of his updates. That's how committed he is. I love to hear Barry talk. I love his passion. You can see him light up when he talks about this stuff. And so I hope you guys all appreciated Barry coming on the call today. I know I did. Barry, thank you so much. Resource Nation, we'll see you guys next week.